Okay, continuing on in our discussion of the FASB Accounting Standards Codification, topic 958, not-for-profits. We're in AUC, or the ASC 958-20, financially interrelated entities. And up until now, we discussed the scope of what types of entities should comply with this financially interrelated entities subtopic, and that was included in the scope and scope expectations. But now we know what type of entities qualify, we can start going through the recognition. So what types of transactions between financially interrelated entities should be recognized and when? So the criteria, the timing, and the location in the financial statements where those transactions should be recognized. And so for this particular video, we'll go through how to recognize contributions received by the recipient entity from a donor, for which have to be sent down to a financially interrelated beneficiary. And it says that if a recipient entity and a specified beneficiary are financially interrelated entities, and the recipient entity is not a trustee, then the recipient entity shall recognize a contribution received when it receives assets, and those could be financial or non-financial. So when it receives those assets from the donor that are specified for the beneficiary. So as an example, a foundation that exists to raise, hold, and invest assets for the specified beneficiary or for a group of affiliates of which the specified beneficiary is a member generally is financially interrelated with the nonprofit entity or entities that it supports. And so it should recognize contribution revenue when it receives assets from the donor that are specified for this particular beneficiary. So we have a lot of examples here that the FASB has provided for us on how to apply the standard. So let's take a look at a few of those examples, and it'll be more clear to us of when to recognize these contributions that we receive that are intended for a beneficiary. So for the first example, we have a corporation, which is the donor, who sends dental supplies to a foundation, which is the recipient entity, and then those dental supplies are sent down to the university's dental clinic, the beneficiary. So we see here that the foundation, which is the recipient entity, can choose the timing of the distribution to the university as the beneficiary, and it can place additional limits on the distribution if those are within the corporation's restrictions, who's the donor. And because of that, the foundation will recognize revenue of the dental supplies, or of the fair value of the dental supplies, as an increase in assets and as a contribution revenue that increases the net assets with donors' restrictions, because the donor imposes restrictions on the use of those dental supplies, and because the university and the foundation are financially interrelated entities. So whenever the foundation receives the dental supplies from the corporation, it records a revenue and an increase in its assets that are donor restricted. And so eventually when the foundation distributes the dental supplies to the university, it reduces its assets and recognizes an expense and the expiration of that restriction. So that's the first example as it relates to recording revenues for contributions that are intended for beneficiaries. So let's look at a few more. Each of them have a difference as it relates to the donor restriction. So in our second example, a corporation, who is the donor, transfers cash to a foundation, who's the recipient entity, and that donor requests that the recipient entity use the gift to provide healthcare benefits to the community. And so the foundation's bylaws require it to support a hospital, a nursing home, and a walk-in clinic, which are all in the community, which connects with the donor's requirement. And so in this case, the foundation, who's the recipient entity, would recognize cash and contribution revenue that increases net assets without donor restrictions, because the corporation, who's the donor, did not specify a particular beneficiary for its gift. And therefore, the foundation can choose how to distribute the gift among the three affiliates, the hospital, nursing home, and walk-in clinic. So this is different than the first example. In the first example, the specific beneficiary was named by the donor. However, in this case, the beneficiary was not named, so therefore it's an increase in net assets without donor restrictions. However, in both cases, the recipient entity, the foundation, records the revenue and an increase in its assets when it receives the donation from the donor that's intended for the beneficiary. So let's take a look at the last and third example. So for this example, there's an individual who is the donor. He transfers cash to the Arts Foundation, which is the recipient entity, and the donor specified that the money is to be used to support the expenses of the ballet, who is the beneficiary. And so they further explained that this Arts Foundation is in an agreement with the community ballet and with the community theater, that if the donor, that's this individual, doesn't specify whether the community ballet or the community theater should receive the funds, then the gift will be split equally between them. But in this case, the donor did specify that he wants this money to support the ballet. So in that case, whenever the Arts Foundation receives the transfer of cash from the donor, then he'll report the assets and contribution revenue that increases net assets with donor restrictions because the donor specified that this cash is restricted for the ballet. And so eventually, whenever the Arts Foundation sends this money to the ballet, then it would record an expense and a reduction in its assets. So all three of these examples are similar in that a donor sends some type of asset to a recipient entity, and then this recipient entity is required to send that asset to a beneficiary that's either named or unnamed. And in that case, this recipient entity records the revenue and an increase to its assets when it receives this asset from the donor, or when it receives a promise to give, or has some kind of claim to the assets.